Hi, my name is Christian Waldegrave, Manager of Research at Teekay, and this is our conventional tanker market update for May 2014. Now, looking back a little bit at the first quarter of the year, rates were very strong through Q1. In fact, in the Aframax sector, rates ended up averaging the highest since the fourth quarter of 2008, and in the Suezmax sector it was the highest since the second quarter of 2010. And that was really due to that very strong spike we saw in spot rates during January, which then extended a little bit into February as well. And the cause of that rate spike was really twofold. One, there was very strong oil demand in China. Chinese crude oil imports were at a record 6.6 million barrels a day in January. And that in turn sucked a lot of oil from the Atlantic basin east. And that's really what gave a lift to the big ships, the VLCCs and the Suezmaxes. And then later on we saw some weather delays in the Atlantic basin, in particular in the US Gulf region and in the Black Sea and Mediterranean. And that further gave a lift to rates and created that very strong spike in rates. Since then we have seen that the rates have come down quite rapidly during March and April, and that's continued into May. And that really is a seasonal thing. You know, we expected the rates would come off the highs of Q1 and go down into the low to mid-teens into Q2, because this is the time of year that refineries carry out their seasonal maintenance, and that's what we've been seeing in recent weeks and months. So in the US, the refineries there had their peak maintenance period in March and April. They're just starting to come out of maintenance now. It's ongoing in Europe, and in Asia it's just starting, and the peak months for maintenance in Asia will probably be May and June. So really for the rest of Q2 we expect that the rates will stay fairly weak because demand from refineries will be low as that seasonal maintenance is carried out. But we may see the rates start to pick up again towards the back end of Q2 and into the beginning of Q3 as refinery output starts to increase. And then seasonally again we get another dip usually around August, September when that second wave of refinery maintenance takes place. So we do expect the spring and the summer months to be largely weak before rates start to tighten again going into the winter market. Looking longer term, we still hold to our view that the tanker market has turned the corner now, that we've probably seen the bottom of the market, and we're in a period now of slowly improving tanker fleet utilization. And that's really being driven by the fact that the tanker fleet isn't growing over the next couple of years, especially on the crude side. If we take the tanker fleet as a whole, we see about 1% fleet growth this year and about 2% next year. But that's really all coming in the product sectors, and particularly the MRs and the LR2s. On the crude side, we really don't see much fleet growth, and in fact, for the Suezmaxes and the uncoated Aframaxes, we think the fleet will actually shrink between now and the end of 2016. And so when you take that static or shrinking tanker fleet coupled with steady demand growth, then we think that the market will start to tighten and we'll see an improvement in utilization and spot rates as we move towards the end of this year, but especially into 2015 and 2016. So that's our conventional tanker market update for May, and we'll speak to you again next month.